Good afternoon, everyone. I'm Erica Plemmons, a senior economist with Bright MLS. It's 3:15, so let's get our Mid-Atlantic Housing Market Update webinar started. If you're interested in housing, the economy, or maybe you're a data nerd like me, you're in the right place. But I understand that we all are very busy. So if you would need to have to pop off of the webinar, don't worry, it is being recorded. And the video, as well as the slides from today's presentation, will be posted on the Bright MLS website, likely sometime next week. We'll get started with a picture of the economy. There is still economic uncertainty in the economy. If you asked economists at the beginning of the year what they thought, they would say that there was no way that a soft landing was achievable. But now some are considering that possibility, though many are thinking that there still could be a mild recession. The employment picture, though, has been very resilient in defying expectations. That top chart is the monthly change in the total US employment. And July's figures show that there were 187,000 jobs added. Now, the figures in May and June were revised downward, though. So that's important to remember. Going to the bottom chart, that is the US unemployment rate. In July, the reading was 3.5%. Since March of 2022, the unemployment rate has ranged between 3.4 and 3.7%. And it's been very low, and this is near historic lows. So that's good news for the economy. Going back to that top chart, though, if we look at the past 12 months, that average was around 300,000 jobs added each month. So currently, we're adding less now than we had been. Still, in good news, the long-term unemployment picture has been pretty consistent month to month. In July, there were 1.2 million unemployed that fell into that long-term category, which is being unemployed for 27 weeks or more. And that's around 20% of all unemployed. So let's take this picture and look at it a bit closer to home. For unemployment in the metro areas, it's always a 1-month lag. So we have data through June for some of the metros within the Bright footprint. For Baltimore, which is the navy blue line you're seeing, and Washington, D.C., which is the lighter blue, you'll notice that both of them are falling under that gray trend for this United States overall. The Philadelphia metro, the orange line, is very similar to the unemployment rate for the nation, which is showing that, in the Mid-Atlantic, we have a good economy. And this is going to tie into housing because we know that people who have jobs are more able to consider purchasing a home and planting roots in an area. When we look at people who have jobs, we want to consider how their wages are changing. Wages have been growing the past several years, but the growth has started to decelerate. The Employment Cost Index, which is calculated by the Bureau of Labor and Statistics, showed that in the second quarter of 2023, that wage growth changed 4.6% year over year. So wages are still growing, but as you can tell, it's come off of its peak. I also was reading about the wage tracker that Indeed calculates, and they do this monthly, and it was updated through July. And the past several months of their wage tracker have also showed this deceleration. So while wage deceleration could help some with inflation, decelerating wages aren't helping people accommodate the higher housing costs due to prices staying firm or rising, as well as mortgage rates. Looking at inflation, we're going to focus on the Consumer Price Index, the CPI. The navy line is our overall CPI. In July, it was up 3.2%, which is a little bit more than the year-over-year increase of 3% we saw in June. Now, the majority of this is due to shelter. Actually, shelter was 90% of the increase in CPI in July. And you'll see that shelter line in green. It has come off of its peak, but it is still very high relative to the overall levels. Shelter is a lagging indicator, and so we expect it to keep coming downward, and in the near term, it should put downward pressure on CPI. But the thing is, shelter is still, there are still prices that are firm or rising, especially for homeowners. And so over the long term, we may see that shelter keeps overall CPI elevated above that Fed target rate of 2%. So consumers are facing a higher overall basket of goods with CPI, and they're also facing higher housing costs. The mortgage rates released this week showed that the mortgage rate surpassed 7%. It was 7.09% according to Freddie Mac. And that is the highest rate since 2002. So if we compare it across history, it doesn't seem so bad long-term, but even over the past 2 decades, this is one of the highest rates that buyers have faced. Now, the Fed's decisions are going to influence our mortgage rate, but it more closely aligns with the 10-year Treasury note. If you look at the spread between the blue, the 10-year Treasury, and the orange, the 30-year fixed mortgage rates, it is about 3%. Now, historically, the spread between those two is about 1.7%. So the spread is larger than typical. Now, there is an expectation, and it's probably already baked in, about the Fed raising the federal funds rate again in September. But any easing of the spread between the 10-year Treasury and the 30-year fixed mortgage rate could cause rates to go down. And actually, if you imagine the spread at 1.7% as opposed to 3%, rates today would be about 6.3%, which for some buyers is a lot more acceptable and would encourage them to come off of the sidelines. Now, we'll have to see how this spread changes over time, because it is dealing with, that economic uncertainty. We don't know if a recession would be coming or not. And just in general, there's still high demand for mortgages. Now, all of the economic picture is going to play into our housing market. Things like the resilient employment numbers, that is good news for housing. On the other hand, elevated CPI putting pressure on the Fed to raise the interest rates is going to tamper demand. And also, we know that the interest rates are not affecting just buyers. They're affecting whether sellers feel like they could sell and buy again. Last webinar, we talked about the pending sales peaking in the Mid-Atlantic in May. So we're going to focus on 3 years. Gray is 2021, the gold line is 2022, and the orange line is 2023. From May to July, you can tell that that orange line, although it has moved downward, it hasn't been as prominent as the decline we've seen in other years. But if we go earlier into the year, into February, the climb from February to May also wasn't as steep as we typically see seasonally. So because there wasn't that steepness, there isn't as steep as a decline. And we'll have to see, do you think these lines between 2023 and 2022 will converge? Well, so far this year, the gap between 2022 and 2023 has narrowed. You'll notice if you go to that bottom table that the average monthly mortgage rate in January of this year was 6.27%. If we compare that to last January, though, that was almost double of what it was then. So as the rates have become more similar throughout 2023, we've seen the pending gap narrow. So in July, what it was a 13.6% difference, but we don't know that this trend will necessarily continue. One of the things I want to point out at that bottom table is the difference between the averages in May and June was 1.2%. And if you do a quick mental math on that July figure, that's 1.4% difference. With rates so far this month being closer to 7%, the gap in mortgage rates could change, which could influence the gap in pending sales. But as we get later into the year, think like October and November, it's likely that rates will be similar or hopefully better, and then we'll see how pending sales compare. Now, in previous webinars, I try to focus on breaking the stats down from just one big number of the overall picture of the Mid-Atlantic. As you know, local geographic areas are different, and another piece of the puzzle is price points. This webinar, I'm going to focus on breaking some of these slides down into the different property type categories. Now, there's going to be some similarities, but we're also going to find some differences. With pending sales, they happen to be very similar. The pending sales trend is showing that the gap is shrinking. For detached single-family homes, in July, the difference between 2022 and 2023 was 15%. For attached townhomes, it was 12%, and for condos, it was 13%. Now, pending sales generally lead into closed sales. Now, this graph has a bit more lines, but as you can see, focusing on orange, which is our 2023, and the gold, which is 2022, the gap between those lines maybe doesn't seem so symmetrical as what we saw in pending sales. Closed sales did hit their peak after pending sales. They happened 1 month later in June. So we know in July we have lower closed sales than we did in June, which is seasonally expected. This is what we are anticipating. But if we look at the gaps and we do this by property type, what we see is there's not necessarily that smooth decline from 1 month to the next. Actually, the peak difference happened 1 month before I started this chart in December of 2022. But one thing is clear, that difference is lower now than it was at the very beginning of this year. But why aren't these trends mirroring each other exactly? Well, one reason is, unfortunately, not all pending sales are going to move directly into closed status. Bright has been conducting subscriber surveys this year. And if you've participated in one of our surveys, just know how much we appreciate you taking the time to do it. And if you receive a survey in a future month, please consider filling it out. It literally takes minutes of your time, and your responses are invaluable to helping us understand some of the shifts that are happening in our market. Now, our surveys had been focusing on successful transactions for listing agents and buyers agents, and how they are working with their buyers and sellers. And we realized one of the pieces of the puzzles we're not thinking about is what's happening to transactions that might not cross the finish line. So in our latest survey, we added a question for listing agents asking if they've been involved in other listings in the past 6 months. And with those listings, have they encountered any problems? And what the survey found is for listing agents that had at least 2 transactions in the past 6 months, 6.3% said one of their contracts fell through because the home did not appraise. And then also 13% said a contract fell through because of obstacles with buyer financing. Now, while these contracts didn't necessarily fall through, it is notable that 21.2% of listing agents indicated that their seller offered closing cost assistance for buyers. And another 15.7% said that they offered other concessions. And these other concessions could be things like there's home warranties on appliances, or repairs need to be done for the home before the buyer's willing to move it. Now, one of the reasons why buyers may need a little bit of a helping hand is we've seen in the Mid-Atlantic, unlike some places like the West Coast, prices are still firm and rising. The median sale price in July was $400,000. And if you look, and it's a little bit hard to tell in April, so let me give you those exact figures. In April of 2023, this year, the median price was $380,974. And last April, it was $381,000, the difference of $26. So if we exclude that April, there's been 89 consecutive months of price growth. And that is a lot of upward pressure on prices for buyers who are now also facing high 7% mortgage rates. Now, the other thing that we need to know is this true for everywhere? Is it true for everything? Breaking it down by property type, we actually see that it hasn't always been like that smooth upward trend in prices. During the spring, the median sale price had small declines in all of the property types. Now, this is something that should be dug into more locally. The Mid-Atlantic covers a broad region. It ranges from West Virginia to New Jersey. There's major metros, there's rural areas. So with that in mind, I'd encourage you to consider your median price statistics for more local areas, whether that's your metro or your county. And you can find the monthly reports with the statistics on the Bright MLS website. Now, along with prices, buyers are facing very limited inventory. Active listings in July were down 19.1% year over year. This is the second month of year over year declines. And you'll see that for July 2023, it's even below that gray line of July of 2021. And even though inventory is declining and buyers are facing constraints, I think comparing it to the past couple of years doesn't give a complete picture. And that's why those blue lines are included in this graph. 2018 and 2019 were more typical times in the real estate market. They were still sellers markets, but they were more, homes were more available then than they are now. So picture, there were 100 homes on the market in July of 2019. Today, if a buyer went to look, there would only be 44 homes. So inventory is 44% less than it was in July of 2019. And that is the top difficulty buyers are facing. In our subscriber survey, finding the right home was difficult for nearly half of the buyers. The next biggest struggle was submitting a successful offer. But submitting a successful offer was a little bit different depending on the buyer type. For first-time home buyers, they may not have as much savings. They are not gaining equity from a prior home sale. And so they have a little bit more difficulty submitting a successful offer than repeat buyers. And that was around 31% of repeat buyers found this a struggle versus 39% of first-time buyers. But on the other hand, when we look at finding the right home, repeat buyers have similar, if not slightly more difficulty finding the right home. 18% of them said that finding the right home was very difficult, and 31% said it was somewhat difficult. And that may be because they are looking to both sell and buy at the same time if they're a repeat buyer. When we go back to our inventory picture, if we focus on the comparison of 2019 to 2023, we can see how the situation has changed for the different property types. Now, the blue is our July of 2019, and the orange filled up so far is how much we have for July of 2023. Now, if you look at the orange fill, you know there are more detached single-family homes on the market than there are attached townhomes, and there are more of them than condos. But relative to where they were in the past, single-family home inventory is the most depleted. It's only 37% of what was available on the market in 2019. For attached townhomes, it was 57%, and for condos, it was 59%. Now, Because there's such limited inventory, buyers need to compete. And we know that the highest struggle is submitting a successful offer. According to our survey, on average, July buyers, and these are buyers who were successful, had to submit 3 offers in order to be successful. And only 31.2% of them were able to submit just 1 offer on that house and get the home. This, of course, varies. As we know, it was more difficult for first-time home buyers. And we can see that about a quarter of first-time home buyers were able to buy the home with 1 offer versus 34.6% of repeat buyers. Now, it isn't apples to apples, the number of offers buyers give versus the number of offers sellers receive, but it's important for us to consider that seller perspective. Multiple offers appear to be the norm in the Mid-Atlantic. On average, in July, those sellers received 3.22 offers on their home, and 71.8% said that they received multiple offers of some kind, whether that was 2 or 10 or 20. Now, this continued competition over homes is also meaning that buyers have to submit strong offers. In the July MLS data, what we found is that 50% of July closed sales sold over their original list price. Now, when we break it down by property type, for detached single-family homes, it's 50%, attached townhomes, 51%. And although lower, still 44% of condo sales had sold over their original list price. And I looked back at this data for not only our July closed sales, but June and May, and the numbers were very similar. Detached single family and attached townhomes, it ranged between like 50 and 52% received over ask. And for condos, it was roughly around 44%. So with buyers competing for limited supply, we want to know, is this going to change? And what we see with new listings data is that, unfortunately, new listings are at a 2-decade low. Our orange line, our 2023, is quite below the other years. And because of this, it's unlikely that our inventory picture will change drastically. If we break our new listings data down by those property types, we see that a typical year like 2019 in blue, 2022 in gold, and 2023 in orange, no matter what type of home your buyer is looking for, it's not like, oh, there's a bunch of attached townhomes being added, but not single family. Across the board, sellers, whether they own a detached single family home, an attached townhouse, or a condo, they all are in those same golden handcuffs. Many of them are locked to those 3 or 4% mortgage rates and unwilling to let them go and trade them in for the 7% rate today. Now, there are still sellers coming and listing their homes on the market. Some are doing so out of necessity. The top reason we found for sellers was family reasons. This could be marriage, divorce, having children. That was 19.1% of our respondents in our survey. There are also other necessary reasons like changing your home because of a job. You have to sell it and move somewhere else. On the other hand, there were some discretionary reasons within the data. There were people who were looking to sell a rental property or an investment. There were ones wanting to trade either to upsize or downsize. So there is still movement, but it is limited because of the factors with mortgage rates. Now, looking ahead to the fall market, what is the expectation? Typically, we expect fall to be slower than the spring and the summer. And I don't think 2023 is different. And according to the agents and brokers who responded to our survey, they agree. If we look at the beginning of these charts, April, May, agents and brokers were more optimistic about buyer activity. And that was because they were looking ahead to months that were April, May, June. Now, the August survey respondents, when they look ahead, they're thinking about September, October, November. Those are typically some of the slowest times for sales. So we see with buyer outlook, less agents and brokers are expecting high or very high buyers. And we also see that there's been an increase in the number of agents and brokers that think there will be low or very low seller activity. Going back to our pending sales, will they be comparable? Now, if we think about our mortgage rates, we are not sure what the next couple months will bring. Maybe October and November, if the mortgage rates are comparable, the lines could be closer. But the other thing we need to consider is the pace of new listings being added to the market, as well as inventory levels for your buyers. So when you're having conversations with your buyers, you may want to bring up how new listings have been slowly being added and how the inventory is trending downward and how that will impact their competition. When you want to dig more into data, I'd encourage you to visit the Bright MLS website. Weekly reports are available, as well as monthly reports for the Mid-Atlantic and the metro areas. Within our monthly reports, there are breakdowns for the counties. I'd encourage you especially to check out our On MLS study. The 2023 version was released last week. And what they found is for properties that were listed on the MLS between 2019 and Q1 of 2023, that they were sold for 17.5% more than similar properties that sold off MLS. There's a benefit to both sellers and buyers for having an MLS where they're able to view properties. And I'd encourage you to check out that study. Now, I hope you learned something today, and I'm really excited to review the chat and the Q&A if there are specific questions that you've had and incorporate that into next month's webinar. Additionally, Lisa Sturdivant, our chief economist, has a monthly market minute that corresponds to our reports where you can hear the latest on what those trends are and how they're going to impact your business. And she's always providing updates about the economic metrics that are released, such as mortgage rates, GDP, CPI, and plenty of other acronyms. And lastly, I'm going to reiterate our subscriber survey. There's a lot more that we're hoping to dig into that and actually provide more granular statistics and metrics based on the areas where the listings are as we accumulate more data. So again, thank you so much for those of you who have participated. And if you do receive one, please fill it out. If there are any questions, I think we have a few minutes at the end of this presentation, and otherwise, hopefully I'll be able to incorporate some of your ideas into the next webinar. Thank you so much. Okay, I see a first question about the MLS report. It is called the On MLS study. Under the research tab on either the Bright MLS website, the public facing when you're logged in, or once you're logged in, there's going to be different navigation subheaders, and one of them should read On MLS study, and that should take you to the report that shows the differences for properties that are sold on MLS and off MLS. The recording, unfortunately, I don't think we're set up to send it out to participants at this time, but I will make sure that it is posted on our website. I know we had a hiccup last month, so I'm going to be diligent and follow up to make sure that is available, and it will be under the news and insights section on the research page. And if I don't see any more questions, thank you so much for attending, and I hope to see you next month.